You and I were having this conversation around the same time yesterday, and you were saying, look, this is likely short-term because of these long-term structural issues. Did you expect it to be so short-term that treasuries essentially have mostly erased their gains of yesterday?
Yeah, I mean, it was the knee-jerk reaction yesterday that I thought would fade a little bit. And when we talk about the size of these buybacks, they're not particularly big in the grand scheme of things. Now, they do affect a little bit some liquidity in that it takes out a lot of long duration or some long duration debt off of, say, dealer balance sheets. But affecting liquidity doesn't necessarily affect the level of yields or the longer term trading. That's going to be driven by fundamentals and also supply-demand imbalances that can be affected by what's going on in the global rate market.
One thing that hasn't changed course of direction, and that is the dollar. It's barely changed this morning, but still slightly weaker. Ira, a conversation also seems to be building that what the Treasury is essentially doing is trying to keep yields in check at the sake of the dollar, and something that could lead to inflationary pressure, a commodity super cycle, and kind of lead an inflation-driven commodity cycle, rather, not a super cycle, and lead to this kind of dangerous feedback loop. To what degree is a weakening dollar after yesterday's move a concern for this market?
Well, I think it's been a concern at least since the beginning of the war, right? And one of the issues has been, will there be a shift in capital flows out of the U.S. or if not out of the U.S., then maybe slower flows into the U.S. And other jurisdictions will benefit. So I think even yesterday when we chatted, we talked about the Japanese yen. And if you hedge the Japanese yen back into certain currencies, it actually yields more than U.S. Treasuries. And so that makes it more appealing for a certain group of investors. So you're not necessarily seeing a lot of selling, but you're just seeing, I think, a bit of a buyer strike. And the thing is, when you have a buyer strike like this, it's going to be hard for the market to rally very significantly unless something changes either fundamentally in the U.S. or you wind up having a reason, like some kind of structural reason, for people to be buying U.S. debt. Now, there is, right? We still have very large insurance companies and other types of flows. And you did see that yesterday. Like, I was talking to an investor in Asia last night, and they did say, hey, we saw a lot of flows into the long end, both of the U.S. and Japan last night from Asian life insurance companies. So it did have some psychological effect. But as you mentioned, it's not going to last very long because nothing's changed fundamentally.